Good morning. Why don't we get started? Welcome to everybody. Thanks for coming. We've got a great audience this morning. I apologize, we may not have quite enough seats. I guess it's better to have too few seats rather than too many seats.
Sit on the table.
There's a table there, not very comfortable, maybe better than standing up. I'm Charles Collins. I'm the director of the Independent Evaluation Office here at the fund. I'm joined by my colleague Prakash Longani, who's assistant director in the IEO and the team leader for our new report on IMF Advice on Unconventional Monetary Policies. And Prakash will give the main part of this presentation. And then I'm very pleased to say that we have Chris Urseg also with us. Chris is Deputy Director in MCM, recently joined the staff after many years in senior positions at the Fed. So I think Chris is uniquely positioned to give interesting perspectives on the report and on work here at the fund. So I'm very glad that Chris could join us this morning. Let me just give a very brief introduction on the IEO, and hopefully most of you are already well aware of the IEO and what we do, but just very briefly, we were established in 2001. We have a mandate to evaluate the activities and policies of the IMF, hopefully contributing to help the IMF to achieve its own mandate, with three particular areas in mind. One, to support the oversight of the executive board, so an accountability mandate. Second, to help the fund as an institution learn from its experience and think of ways to strengthen its performance going forward. And thirdly, to increase the transparency of the IMF to the outside world and hopefully to increase, therefore, the credibility and legitimacy of the IMF. I think we're pretty well established now as a key component of IMF governance. I encourage you to visit our website to see our previous evaluations. We're a pretty small group. We have just 15 full-time staff. We hire multiple consultants to work on our evaluations, to give us a full expertise on the issues that we're addressing. But we only have capacity to do a couple of reports a year, so we need to make sure that we're choosing the right topics for those reports where we can really help the fund to learn in an area that has been challenging. So why did we choose this particular evaluation? There we go. Essentially, we look back at unconventional monetary policies, clearly the core area of the fund's work and mandate, and the experience of implementation of unconventional monetary policies over the past 10 years or so since the global financial crisis, I think raised two quite fundamental challenges for the fund. First of all, could it provide value added in its advice on monetary policy, and could it influence monetary policy decision making among the major central banks and a number of other central banks that were implementing new out-of-the-box policies at a time when the conventional toolkit had been exhausted, and I think central bankers were desperately looking for ways to address a very difficult situation after the global financial crisis that persevered for many years thereafter. And then secondly, and more broadly, could the fund be helpful in its role of giving advice to countries being affected by the spillovers from extremely easy monetary policies at the core of the system. So here we looked at the advice given to emerging markets, many of which were feeling strains because of the spillovers from these policies? And could the fund help to promote cooperative approaches to monetary policy formulation? In fact, if you look back at the Articles of Agreement, you'll see that the first article specifically mentions that promotion of international monetary cooperation should be one of the key tasks of the IMF. When we started the evaluation 2 years ago, a number of people asked, well, why are you doing this now? Shouldn't you wait for a little bit longer, wait till the cycle plays out, rather than do the evaluation at a time when QE was still being used, when interest rates were still negative in many jurisdictions. But we felt it was important to move ahead quickly because we foresaw that if we could bring some lessons from the experience with UMP over the past 10 years, those lessons could be useful to help the fund going ahead at a time when the global economy may again be moving into a slowdown, a downturn, and at a time when central banks again have very limited conventional ammunition. So we'll again be looking for innovative solutions to dealing with challenges that they face. So we thought it was very timely for us to do this evaluation, and hopefully the lessons that we've drawn will be helpful to the fund going ahead. Let me now turn over to Prakash to give the main evaluation presentation, and then I'll come back and talk a bit about the reaction of the board to the report and the steps going forward, and then turn over to Chris for some comments. Prakash.
Thanks, Charles, and thank you all for coming. Apologies that some of you have to stand and some are on tables. But thanks very much for your interest in this report. The report was pretty broad in its coverage. It had both a number of country cases as well as thematic papers, and I'll describe each of those in the coming slides. It became very clear to us from our early review of the documents from the fund over this period that the fund quite quickly developed what we call the corporate view on unconventional monetary policy. This corporate view had three parts to it. First, the IMF was very early in supporting UMP by the major advanced economies, and it was fairly steadfast in this support. The policies were debated internally quite a bit, but publicly the IMF always maintained very strong support for UMP. In 2010, the IMF supported a pivot to fiscal consolidation, and after that it became even more supportive of UMP as the only sort of major policy tool that was providing support to aggregate demand. The second leg of the corporate view was that the IMF advocated the use of macroprudential policies as the first line of defense against any financial stability risks that could emerge from the use of unconventional monetary policies. So it did not tell countries to step back from UMP out of fear of financial stability risks. It said use this other instrument, namely macroprudential policies. And the third is that even though, as Charles said, the IMF did recognize that EMs were facing challenges, on balance, it said that what is good for the advanced economies is also good for the global economy, and therefore it continued to urge that UMP be pursued in the advanced economies out of a belief and the view that on net this would also be good for the global economy and for other countries. To provide an assessment of this corporate view, we turn to the three experts shown on the left there, and they came to the view that the IMF deserves considerable credit for its rapid deployment of support for UMP at a time when some central banks were pushing ahead with these policies and there was some hesitation on the part of other international institutions, the IMF came out and provided very strong support for these policies and deserves a lot of credit for doing so. The assessment also reached the view that the IMF was right to basically say that, yes, there are potential financial stability risks from UMP. Yes, they have to be monitored, but that there was no reason to kind of step back from UMP out of kind of an undue worry about these risks. So our assessment is that the IMF basically made the right call on the financial stability risks, given the exceptional circumstances facing the global economy at that time. We also found, as we know from our APRs, areas for development. We think that having put its weight behind these somewhat experimental policies, the IMF could have done more in the area of assessing the effectiveness of these policies. The central banks who were putting in place these policies were, of course, assessing these impacts themselves, but they were caught a bit in a situation where, having put policies in place, they could not come out and criticize those policies themselves in a very open way. But the IMF was completely free to say, well, this is working, this is not, and it could have brought its cross-country experience and expertise to assess the effectiveness of these policies in a more forceful way than we think it did. We also feel that the IMF could have done more to analyze what was the right mix of monetary and fiscal policies that was needed for the situation. We feel, with the benefit of hindsight, that the pivot to supporting fiscal consolidation in 2010 was too hasty. It could have, the IMF could have made a different call. It's true that as the evidence came in that the global recovery was remaining weak, that the IMF, kept modulating its position on fiscal policy, saying, there's no need to be hasty about consolidation. Countries that have space should use it. And then the IMF was forceful about saying, if you are doing the adjustment, make it as growth-friendly as possible, as the FTMD, I think, stressed repeatedly. So I think the IMF did modulate its position, but we think that, as Charles was saying, one of the purposes of this exercise is to think ahead of what advice we would give next time to us. This is an area where the IMF could, in a more systematic way, think about what is the right advice to give on the mix between monetary and fiscal policies in the event of the next downturn. And as I will describe, we did a lot to support EMs, but again, you will see that the EMs feel that more could have been done for them. On the advice to the major advanced economies, the Fed and the Bank of England moved very quickly, as you know, and so the fund's advice was, the fund's role was largely one of validation of the actions that were taken by these two central banks. There was a fairly vigorous internal debate at the surveillance meetings and in other forums, particularly of QE1, but at the end of the day, having decided as an institution that we were in favor of these policies, the fund very strongly validated actions by the Fed and the Bank of England, and this was appreciated by the central banks, particularly in England, where the IMF's view makes it often to the headlines of the Financial Times, and IMF lack of support would have been noticed and been difficult to manage. So I think the central banks were quite happy to get the fund's support. In the case of the ECB and the Bank of Japan, which were moving more sluggishly towards QE, the IMF was quite forceful about telling them to move ahead, particularly with the ECB in the 2010 to 2012 period. Here, our reading of the evidence and talking to fairly senior people at ECB confirmed that at this point, during those 2-3 year period, interactions with the IMF were actually quite useful because they were in the process of making up their own minds, trying to reach a political consensus within the ECB institutions on how to proceed. And workshops that were organized with the IMF, other forms of behind-the-scenes interactions were actually quite useful to the ECB in moving things forward. With the BOJ, there were some clashes of view, so there was a bit of tension in the interactions, but nevertheless, I think the IMF proved prescient in the kinds of advice it gave. And when Abenomics was launched, the IMF was quite a cheerleader for it. It should not come as a surprise that relative to the central bank's own analysis and work, we could not find evidence that the fund's own analysis brought tremendous value added. I mean, it was always appreciated. It was always good for these central banks to have an independent view from the IMF, from equally trained people to validate what they had done, but it was not as though any piece of IMF analysis really changed the game for how these central banks were thinking. We found that these institutions, even these very top institutions, big institutions which have huge research staffs of their own, nevertheless found the fund's multilateral research very useful. The WEO, the GFSR were read very carefully, and often there were ideas in there that were very useful to these central banks. We were a bit surprised that the authorities in some of the smaller advanced economies told us that the fund was perhaps not as useful as it might have been. These are countries like Denmark, which moved to negative interest rates in 2012. The authorities there told us that they went through a long internal process of brainstorming about should they do this, should they not. They consulted a few peers at other central banks. They consulted selectively the BIS, but did not reach out in a major way to the IMF. Similarly, the Swiss and the Czech Republic, when they put in exchange rate floors, had minimal amount of interactions with the IMF in the design and implementation and when to put in these floors and when to exit from them. So it was a bit of a surprise to us that the IMF was not able to provide the toolkit that these economies needed at the time. Interest rates had been coming down for quite a while before the Great Recession. There could have been some forethought about, well, what will these economies do when interest rates hit zero? So it was, again, to us, this is perhaps a room for improvement of thinking about how the IMF could be used more by these countries as a source of external advice. The emerging markets, we surveyed most of the major emerging markets, many of the major emerging markets, India, China, Brazil, Mexico, Turkey, South Africa, ASEAN, Korea. And what we learned from them is that the Article 4 process is truly valued as a once-a-year check on the macro framework. So it's the central banks find it really useful to get the fund's view on how the fiscal, monetary, and other policies are interacting together to deliver on macro outcomes, and that's a very useful exercise for these central banks. On the monetary policy aspect itself, the central banks felt that they were expecting and would have liked somewhat deeper expertise and more market awareness on monetary policy issues. The feeling was that the fund brings some expertise, but it's mostly at a sort of high level of thinking about how the framework fits together, which is extremely valuable. But on monetary policy per se, the feeling was that the fund is not bringing the depth that may be needed to really make a contribution. As with the advanced economies, the emerging markets also really valued the fund's discussion of global developments, and they would like to see more discussion of cross-country experience. When you go through the staff reports, you often do see boxes and other sections that are devoted to cross-country experience, but the feeling we got from the authorities when we spoke to them is that during the Article 4 consultations itself, those boxes and other pieces of evidence don't rise to the top. They get the sense that they are being lectured to a bit on what they should do without it being kind of a discussion of here's what's going on in other peer countries, here's what you might do or not do. There's a feeling that it's still a little too prescriptive rather than being a true consultation. So the staff report looks like everything was covered well and there was cross-country experience, but when teams are sitting across from the policymakers, the policymakers are still feeling that they're getting a bit of a lecture that they may not need at this level of their expertise. The institutional view was welcomed as showing that the fund is not doctrinaire, it's willing to be flexible. So it was truly appreciated, particularly in India and Brazil, which had moved ahead on using capital controls, or CFMs as we like to call them. It was a step forward, but there are still concerns that the way the IV is being implemented, that it's very restrictive. I'll come to that a little bit more. On fostering international monetary cooperation, this has always been a difficult exercise historically for the fund to bring together countries and particularly to get its major shareholders to listen to it. This decade was no exception to that general characterization. There was a moment where the G20 coalesced, provided the global fiscal support. The IMF played a very important role in that exercise, as you all know. But subsequent efforts were not as successful, partly reflecting the fact that the G20 itself kind of lost focus on trying to pull together and get the global economy moving in a certain direction. The spillover reports were welcomed as a sign that the fund was taking spillover seriously and that was trying to really understand the channels through which developments in advanced economies were affecting the EMs. But at the end, it was felt that there were no real analytic breakthroughs on understanding financial spillovers, and it played very little influence on policy advice. I was sorry to discover this assessment since I was a leader of one of the spillover reports, but that's one of the dangers of being at the IEO, is that you get criticized yourself. As I said, the institutional view was appreciated, but it has not worked to, as we say in the report, almost any country's full satisfaction. Some countries, like Mexico, told us that they worry that it's providing an open blessing for capital controls. Others, many in Asia, particularly among the ASEAN economies, said they found it too rigid and it's not supportive enough of the use of CFMs, particularly as a permanent measure of the toolkit that can be used along with other tools depending on the trade-offs that countries see. The FCL, it was launched, that was successful. The fund's previous attempts to launch a precautionary line had not been very successful, so I think the fund deserves credit for being able to launch it. The 3 countries that used it found it very useful. We did a detailed case study of Mexico. Among the 3, Mexico found the FCL extremely useful and supportive. But again, it was only limited to these 3 countries. Many other countries told us that there is still a stigma associated with coming to the fund, even on a precautionary basis. This was told to us by authorities in Indonesia, particularly, who said that on a technical level, they had made the case to the political authorities that there should be a FCL, but in the end, on political grounds, it was felt it was too sensitive to approach the IMF. And this is the last of the background papers that I'm describing. We looked at some of the issues that are being debated actively in central banking circles. Those are the 4 issues that I list on the top bullet. How should UMP be considered as part of the convention? Should UMP become part of the conventional toolkit? Is inflation targeting still a framework that is appropriate? If it is appropriate, should the inflation target nevertheless be raised? Paul Tucker wrote this book on how central banks had basically become had gained too much power, and they had not been elected to have that much power. So there's a lot of discussion on whether the governance and accountability of central banks should be revisited. And finally, there's a lot of discussion on central bank digital currency. So Andy Levin, who wrote this chapter, is an expert on CBDC, and sort of reviewed some of the work on this topic as well as others that the fund has done. So here we found that the fund is indeed working on all these issues. There are lots of initiatives. But nevertheless, among the monetary policy experts we spoke to, it was felt that the fund is not at the cutting edge. It's one of the players, but it's not really that the fund is leading the discussion and debate on these issues. The exception was Olivier Blanchard's call for the inflation target being raised to 4%. Okay. We also covered a number of institutional and HR issues that affect not just monetary policy, but fund surveillance more generally. On UMP, as I alluded to, we felt that there was internal discussion, particularly of QE1, but in the end, there was no structured process for deciding, for evaluating the advice. And particularly, as I said, it was unreasonable to think that the fund could be in the operating room as these central banks were devising these policies. But the fund was getting all the lab results, just as the central banks were. The fund could have been in the forefront of saying, well, you guys, meaning the central bank, said recovery will happen by X time. It hasn't. Why not? You said inflation will go back to target by X number of years. 5 years later, it's still not out there. So there was no, in our view, process of saying, well, we have put our weight, our considerable institutional weight behind these policies. Let's keep assessing the evidence and see how we should calibrate our support for these policies. The other points are sort of more general and could apply to other aspects as well of surveillance. Monetary policy is competing with newer priorities. We found that when we spoke to monetary policy experts, both at central banks and in academia, that there was a sense that the fund did not have a cluster of thought leaders who could really stay engaged with cutting-edge debates and then inform the country teams as needed. We also found that many authorities told us that the frequent turnover of mission chiefs and country teams comes in the way of developing deep expertise, which is particularly needed on monetary policy issues. Okay. I'll end with a few slides that show you how we think these institutional and HR issues are coming in the way, and then move on to the recommendations. I'll hope to wind up in 5 or so minutes. We looked at what country teams were doing in terms of their SIPs, what chapters, as an indication of where the fund staff were conducting some deeper analysis of issues. And what we found was that monetary policy, both in the decade prior to the one we were studying and in the decade we were studying, monetary policy and UMP in the more recent decade took up about 14% of SIPs. So that fraction remained the same, even though monetary policy was arguably something that needed greater attention. The attention went, I think, appropriately to financial issues. Those went up from 22 to 28%, and it went to new macro structural issues, which went up from 5 to 11%. A lot of this is actually, when you look at the details, labor market issues and jobs and growth, which I'm partly guilty for. When we looked at the turnover of mission chiefs for the countries that we studied, this gives you the number of IMF mission chiefs over the roughly decade that we were studying. And you can see that Japan had as many as 7 mission chiefs over this period. And other countries also had lots of mission chiefs. The lowest was the UK and the Euro area. The orange line is the target that management sort of agreed to in an implementation plan on one of our previous reports. So you can see that in almost every case, the turnover of mission chiefs is sort of much larger than what was agreed in this implementation plan. And I think many countries told us that this number of turnover among mission chiefs means that it's really not somebody that you're going to develop a deep relationship with if the person is going to leave the next year. When we looked at turnover on country teams, we found that only about 60% of, we found that 60% of staff only go on one mission to the country, and it's really very few staff that go on multiple missions, so 3 or 4 missions, which you might think is the time you may need to really develop close relationships, deep expertise. It's not common among IMF staff. Okay. So our recommendations flow from the findings that I have just described. We make 4 recommendations to help the IMF raise its game on monetary policy issues. We think that the fund needs a core group of monetary policy experts. This is something that I hope came through in the findings, that you need at least a few people who are at the cutting edge, able to engage with the central banking community, with the monetary policy community among academia, and at least be abreast of what's going on and perhaps actually contribute to some of these areas. And then we think that expertise can be put at the help of country teams when country teams are faced with a demand from central banks, like Denmark was faced when it was thinking about negative interest rates, to give sort of solid advice to countries when they need it. We think that having a core group of experts would also help in developing a playbook of policy responses. Again, going back to what Charles said, is a critical aspect of why we are doing this evaluation is that the next time a downturn occurs, the fund should be better prepared to give countries monetary policy advice. And so developing kind of a scenario analysis of what we would do or how we would advise countries is something that is useful. The IMF has a number of policy papers, but those, I think, need to be updated so that it's more useful to countries. We think that financial spillover analysis has taken a bit of a backseat after the abolition of the spillover reports. It is going on, but I think needs a renewed focus. So I think perhaps I will not go through in great detail on each of these. This, I think, repeats a bit of what I said in describing the previous slide. We need to bring a core group of monetary policy experts. We think it's important to assess the cross-country experience on the use of UMP so that the next time we can give countries good advice on how effective UMP is likely to be. As I alluded to, we need to be more attentive to the issues of the policy mix, particularly between monetary and fiscal. We need to make sure that macroprudential policies are effective. We've made that the first line of defense against financial stability risks, so we need to make sure that those are being effective. And we need to pay greater attention to the distributional impact of UMP. That came up as a theme that authorities told us that that's something that was missing from the fund's work. Okay. We think that we need to re-energize the financial spillover analysis. And part of this is to reassess the IMF's advice on capital flows, which we are doing in a new evaluation that is just getting underway. And finally, on country engagement, I think authorities have told us, and the IEO has recommended in the past, that the length of country assignments should be extended. And I think there should also be ways of trying to engage with central banks outside of the Article 4 consultation cycle. Many central banks told us that those forms of engagement were very useful for them, either at the annual and spring meetings or at workshops organized sort of off-cycle or during the Article 4 consultations that give them a sense of the cross-country developments and global developments. So with that, let me turn it back to Charles.
Thanks so much, Prakash. I'll talk briefly about the response to the report and the follow-up to the report. I should just emphasize that at the IO, we say our job not just is writing nice reports, hopefully we do write nice reports, but we really want to help the institution to learn and to be a catalyst for change, to make the IMF even stronger at fulfilling its mandate. So we have a fairly well-structured process for following up on the reports. The first and critical stage is the board discussion of the report. It took place on June the 5th. Before the board meeting, the managing director circulates a statement about the evaluation, giving her view, the staff's view, and reaction to the report. Her reaction to this report was positive. She appreciated the recognition that the fund had done an impressive amount of work related to UMP. But she also accepted that there was room to improve the timeliness and the value added of the fund's work on monetary policy issues. The board was also broadly appreciative of the report, and they supported the recommendations that we made. All four of the recommendations were supported. This is important because the follow-up to the report depends crucially on the board's endorsement of recommendations. The board was supportive of the overall headlines as highlighted by Prakash, but there was quite a lot of discussion at the board on the details and different views on exactly what should be the follow-up. And I think that'll be useful to staff as they think about what is the best way to move forward. I think one of the areas where there was most discussion, and I think quite an interesting discussion, was on the question of what should be the fund's monetary policy expertise. Many directors made the point that the fund should not try to compete with the very deep expertise at major central banks. The Fed, Bank of England, ECB, the Bank of Japan are always going to have far more high-quality expert resources on monetary policy. So the recommendation should focus then on building expertise in areas of the fund's comparative advantage. We certainly agree with that, and in our report we basically highlight three areas of comparative advantage that the fund should have. One is the broad membership, so it should be able to bring to bear lessons from the broad experience across the membership. The cross-country lessons that as Prakash said, have been somewhat lacking. Second, the area of looking at monetary policy in the context of the overall macroeconomic framework, which is something that central banks are really precluded from doing, since they have a much narrower mandate. I think the fund can bring useful perspective looking at across the whole macro framework, and again that was an area where we highlighted some shortcomings. And then thirdly, looking at cross-country effects of monetary policy, particularly the spillovers and the advice to countries being affected by those spillovers. And again, we have particular recommendations to strengthen the fund's work in those areas. I think the one area of our recommendations got the least support, the least resonance, was the call to have some fresh thinking about ways to strengthen international policy cooperation. I think there's a fair degree of maybe fatigue with 10 years of heightened G20 not producing very much, and no one was very hopeful that this would be very fruitful. But I think it does remain an area where the international community as a whole is perhaps falling short. And I note that the eminent persons group of the G20 also called for new efforts to strengthen cooperative approaches. In terms of the next steps of follow-up to the report, after all our evaluations, staff prepares a implementation plan to provide a detailed roadmap for moving forward with the recommendations that the board has endorsed. So we look forward to that around the end of the year. But I think in practice, the findings in the report are already feeding into a number of fund work processes. I think the timing of the report was good because it feeds into, provides material for the comprehensive surveillance review, which is, as you know, is now underway for delivery early next year, as well as input into the new HR strategy that's being developed, and the budget discussions. And I would note that there's already been some progress in important areas. The fund now does have expertise of people who are indeed very much plugged in and respected as thought leaders in monetary policy. So very much welcome, Chris, to the fund, and maybe it's a good segue to pass you the baton. Interested to hear your response to the report and how you see the fund could most effectively respond.
Well, thanks very much, Charles. You put my microphone on. So, I found this to be a really very insightful and meticulously researched report. I thought it was very constructive. It's something that I would expect from something led by Prakash. I don't know if people know that I was his research assistant 30 years ago at the Chicago Federal Reserve Bank. And I was
very
always
clear to people that our roles should be switched.
I was impressed by the really clarity of your research and vision. So I think I'll start by just taking a few minutes to think about how MCM has taken steps to deepen its analytical work in the realm of monetary policy in a way that closely aligns with the guidance provided by the managing director and the executive directors in response to this really, I think, influential report. So first, we've built a macro modeling unit within MCM comprised of a group of really extremely talented economists. Jinping and Francis, I see right here. We have a number of other members of the group that aren't present. Jesper Linde from the Riksbank will head the group. But I think it will bring strong expertise in monetary policy and macro modeling, as well as a deep knowledge of the models that are used within the fund and other institutions. Indeed, many of these people come from other institutions, the Riksbank, they've had experience at the Bank of Hungary, at the Fed, and they can bring that experience to bear. I think, importantly, team members also have extensive experience in working in area departments, TA missions, and as I mentioned, central banks. So this will all be important experience that will help with the practical policies that we're going to confront. We need to make these modeling efforts practical, and this experience will facilitate that. So a second, support of the IPF, the Integrated Policy Framework, is really a core part of our work stream. So the broad goal of the IPF, of course, is to help policymakers understand how tools in addition to the policy rate, so foreign exchange intervention, capital flow management tools, can be utilized to help central banks achieve their objectives. And so we're really thinking in terms of a multifaceted strategy. It's partly empirical, it's partly model-based, so it'll draw a lot on case studies, the cross-country comparisons that are really a strength of the fund, but also utilize our models to help think about these policies in a systemic way where we can trace through all the channels. So I think it would be very important to think about what are the potential benefits and costs of these policies. For instance, FX intervention can play a salutary role in perhaps boosting inflation towards target for countries that are experiencing these challenges. That's alluded to in the report, Hungary's case being an example. It could help insulate the export sector from pressures that would come from strong capital inflows that cause the exchange rate to appreciate. So that's another potential use. But we also have to think about the cost of these policies. For instance, it could undermine confidence in the central bank's focus on the inflation target. So it will really be important to think about both the potential benefits and costs of these policies. So in that vein, we're developing small-scale models that would apply for smaller open economies, including lower income countries. And these will incorporate many of the channels that we think would be relevant for thinking about the prospective efficacy of these additional tools. For instance, balance sheet channels that would embed currency mismatch. So we're going to estimate these models for a large set of countries, and we think it will be a useful extension of FPAS work that's been done in the past. We're also going to employ somewhat larger scale multi-country models that can help us think about the effects of macroprudential policies. And because these policies are quite complex, they require more detailed models. For instance, a fleshed out housing sector to help think about the prospective effects of changes in loan to value ratios or in debt service to income ratios and how those would play out in a general equilibrium context. We'll also use these models to think about spillovers. So how would the implementation of FXI policies, perhaps in a broad set of emerging market economies, affect advanced economies? So I think it's worth underscoring that this analytical work will strongly complement the work of area departments. It will support Article 4 and TA missions. So that would be a key goal of this. It would also help facilitate our multilateral analysis of spillovers. So beyond this, we're also, in line with the report, really want to investigate the effects of monetary policy actions in the advanced economies, including, as underscored in the report, the sort of prospective tools that can be used to confront recessions. But we also want to consider how these tools can eventually possibly cause financial stability risks. So they'll certainly be key focal points of our analysis. And I think the fund has a very distinct advantage in some ways over central banks in thinking about the array of policies that countries may deploy to achieve their objectives, including fiscal tools. And just to reinforce Charles's remarks, I think central banks are limited in some ways because they've got to focus on what they can do through monetary policy alone to achieve objectives. And even Bill Dudley has recently said that that can potentially lead to misplaced policy conclusions. If it's got to be all in the central bank, then you might say raising the inflation target is a reasonable sort of thing to do. But if you can think about the confluence of different tools that can support achievement of objectives, and maybe it would involve steps like using deeply negative interest rates in the context of CBDC, then you really can get to potentially different outcomes. So, with that in mind, I think there are a few key characteristics of our modeling efforts that I'd like to stress. One is that they're practically oriented, that we want to really think about the challenges that many countries are facing. And for that, we really will draw heavily on the analysis of area departments. So I think there's going to be a lot of reciprocity between work, both in empirical and structural modeling, and the efforts of area departments. There's got to be a lot of open communication and dialogue between the two, because so many of these areas are just involve many unknowns, and working together we can, I think, make a lot of progress. So I think it's helpful, again, to underscore in that vein that people within our groups have a lot of experience working in area departments, but close collaboration going forward will be, I think, essential. So finally, I want to say that it's important to also think about leveraging up, of course, across the fund, so that there'll be a lot of work done across departments with RES, with SPR, with other departments, as well as with other institutions, including the BIS, as well as academia. So I think that really we want to think about leveraging up in this enterprise. Well, thanks.
Well, thanks so much, Chris. I think it's a really impressive and ambitious agenda you have, and I think it's a good opportunity for you to really talk throughout to a good audience here. Because as you say, it's going to be a group effort.
Yeah.
You're a small team, but then the key is to work with
That's right.
across the fund.
Absolutely.